Yo, what up YouTube? Welcome back to a new educational video. In this video, I'm going to explain a few variations I use on my time frame alignment model and how I got max allocation with FTMO, and I made $33,000 in June. All the certificates will be on screen, of course, over here to show you it's not fake and I really make money trading. So you can trust my word when I put out an educational, unlike some other YouTubers and educators. But let's just start off with this educational. Alright guys, welcome to a new educational video. We're gonna go over a few topics, and if I just pull up the topics over here, first of all, we're gonna refresh our order pairing knowledge. It's very important when we're trading the time frame alignment model. We're gonna talk about 4 hour to 1 hour sequence. We're gonna talk about the 1 hour to 50-minute sequence. Then when not to buy or sell all highs and lows. Sometimes a price does not take out a high or low, or you're just not sure if it takes out a high and should I wait for confirmation or should I just sell the high. I'm going to explain what to wait for and when not to do it. And at the end I do a little simulation, executing a confirmation entry, but this time no random date because sometimes it takes long to find a proper example with a random date. But let's start off with order pairing, right? We're refreshing our knowledge. Just a clear schematic over here, right? We have discount and premium, and we're always using a bigger range and looking for a smaller range within that bigger range, right? That's what we're gonna do. So the range high over here is an order pairing high within the bigger range, and the order pairing low is attached down in discount. The time frame alignment model, whatever sequence you're using, always has this. So you're always selling above an old high or buying below an old low. Now, what does that look like on the chart? Over here, for example, we've got a high and a low, which both got purged, right? We've got buy stops above the high here, which is the basics of order pairing, right? We want to pair up the buy stops with the sell stops below the range. And this is in bearish order flow. So we want to look for a continuation trade. And first of all, you need to be aware what is the premium and what is the discount over range. Now, using a proper interbank dealing range, we want to see buy side and sell side get purged, and we're using that range to trade from. So we can see buy side got purged over here, right? And then the low got purged. So we're having a new range over here with a smaller range inside of it. Now, if I mark out the order pairing high and order pairing low, we have the high over here. And important with order pairing, we want to have these highs around equilibrium of the range. Then we're going to target the order pairing low, which is attached to that high over here. So we want to turtle soup the order pairing high and then continue down lower. That's the basics of our order pairing. Same thing for a bullish scenario, right? We want to have premium and discount. Price runs higher, forms a smaller range within the bigger range over here. Then we want to use that range low, which is around equilibrium, as our order pairing low to buy and then pair up the buy stops above here. Right, that is the basics. Now, how does that look like on a chart? So we want to have a defined range, like we want to have a dealing range with premium and discount. Now, over here, we did not take out buy side or sell side. We did actually take out buy side, but we can see to the left, but we didn't take out any sell side here. But we have to think about market cycles. This is in an expansion phase, so price is unlikely to go all the way back down through these lows because we already formed a set of down close candles here, right? And then we started to consolidate. So we have a nice AMD schematic over here. So with this accumulation happening over here, we can see price runs up higher. Now, due to market cycles, we know that this is a reversal and then a consolidation. So if it runs higher, that's most likely manipulation. So that's why this order pairing low and high is so really good, because first of all, we're taking out the buyers over here, then price drops, and then we take that order pairing low into a key level. And then we run the high. So this is a bullish example on order pairing. Now let's talk about the execution sequences, right? We have the 4 hour to 1 hour, and then we have the 1 hour to the 50-minute. These are the two sequences I use, and the variations I use upon them always stem from the order pairing in these sequences. Now, you don't want to buy all the highs and lows when you're around daily rollover. So that's when the candle closes and the new daily candle starts. We don't want to order pair inside of a consolidation. We always want to be in an expansion phase on the higher time frame or on the 4 hour on the minimum, because we don't want to sit in consolidation. It's going to be very hard to order pair because we're just range bound and there's nothing to order pair. We don't want to look for old highs and lows in decoupled markets, which literally means sometimes you, for example, when NASDAQ trades higher and you can see YM dump to the floor and then ES is just hanging around, is totally decoupled. We just want to stay out of those markets, right? So as a rule of thumb, decoupled markets, you kind of never want to trade those. And then when the highs and lows are too far away from equilibrium, you can see it because of the camera, but there it says equilibrium. So that's the middle point, the 50% level of the range. Why? Because if there is no high or low around equilibrium of the range, it makes the order pairing lower probability, because if it's that high, let's say you're buying and it's that low inside of the range, it's not really order pairing. It's just a cycle into an expansion and then into a reversal. So that's not order pairing at all. Right, so let's do the 4 hour to 1 hour confirmation entry. We always want to know what the order flow is, right? We don't want to randomly buy and sell old highs and lows or randomly use the sequence. We've got a purge on the high in bearish order flow, and then we want to aim for the low down here, right? So we're in bearish order flow and we had a purge on a high on the 4 hour. Now, what do we want to wait for? We want to have a clear order flow to the downside, because we don't know if we're going to go bearish once we tapped into the fair value gap here and it starts to trade higher. If at this point we don't know if it goes bearish, right? So I always use a double dealing range, and I have a video on that as well. It's an easy guide on ICT dealing ranges. And the same scenario applies here. First of all, let's pick out a key level. So the key level is the 4 hour, right? Because the sequence is 4 hour into 1 hour order pairing. We have this key level over here. And if I zoom in onto the 1 hour, it makes it a little bit more clean to see what's going on over here. What we have over here is the low that we want to attack, right? We can see the break of structure on the 1 hour, but it was still indecisive on the 4 hour. So we wait for the second range to get formed. So when you trade market maker models, also have an episode on that. I almost always trade the first stage distribution. So I let the low risk sell pass and then I'll trade the next distribution phase. Same thing over here. We have the 4 hour key level. First phase has, or the low risk sell has formed, then the next phase starts. This is the phase I always want to trade. So over here, we've got that old high. This is where the order pairing happens, because we already have a confirmed dealing range, and then we want to sell into that key level. Now, over here, we might not know if we're going to go bearish from this key level. And there's two things why I say that. The fact that we have SMT on these lows, because I don't have the chart here, but we took out this low over here, and price starts to push up higher with displacement, right? This is a V-shaped recovery, right? This might as well just go full-blown bullish again. If this was a consolidation over here, and then it goes into the key level, makes it 100 times better, because then we can aim for those market cycles, right? Then we have the consolidation into a retracement and then an expansion, because we never reverse from a consolidation. That's what we want to keep in mind. I want to wait for confirmation over here. How do I do that on this sequence? You can do two things. You can do, you wait for a 1 hour CSD OB. That's one thing. Or you go to the 15 minute and you wait for a CSD OB there, but we're going to use a wider stop loss then. So if I go to the 15 minute, and this, these are bonds, so the candles look kind of weird, but this is just how it forms. We're in that key level, and you can see price actually keeps pushing up all the way until it fills up that 4 hour fair value gap. Now, what we can do here, we can wait for a 15 minute CSD OB. And we can see that over here, right? Price runs higher, then we start to close below, and then we just literally sell the CSD OB. But what we gotta do is put our stop loss higher, because there is still a chance that SMT can form on a lower time frame CSD OB, while the higher time frame, the 4 hour and the 1 hour, stays respected. So we're going to use a little bit of a wider stop loss, but still use the CSD OB as an entry, because this indicates that intraday, the 15 minute is willing to go bearish, right? And the 1 hour is not ready yet. And typically you want to have all the time frames aligned. So the 4 hour, 1 hour aligned for bearish. That makes it higher probability. Hence the little bit of a wider stop loss. Now let's talk 1 hour to 15 minute sequence. And this one is actually, we're going to use a different type of entry. We're not going to use a CSD OB or a fair value gap or anything. the 1 hour to 15 minute sequence, we're going to use the double dealing range technique, which is really good on the lower time frame for an intraday expansion. So we've got this chart over here. Always start off with premium and discount, very important, can't stress that enough. A lot of people fail to realize that you don't want to buy fair value gaps in premium. We only want to use the discount ones, right? We have the 1 hour key level over here, which is in discount. So this should be good to go higher, right? If we look at this high over here, that's what we want to target. And we zoom into the 15 minute, we have an old low down here, right? Old low down here. But this is a great example when not to buy an old low. Now, why do I say that? Because we're around daily rollover. So this piece of price action looks great if it was during New York session or even London session. But this over here is exactly at the daily rollover. And everybody who trades real live money knows that the spreads can be horrible. Sometimes on a demo account, it doesn't show that much, but slippage is real and you don't want to have a limit order just around daily rollover. Especially, for example, this is a gold chart. Let's say I had a limit down here and overnight price gaps down and the spread is so wide that we get filled up here, then our risk to reward is just ruined. So you want to avoid daily rollover over here, but how can we catch that afterwards? Now we're going to go and zoom in a little bit over here. This is the daily rollover, right? Remember, we still haven't taken out buy-side liquidity, but we're actually doing the same thing over here, but on the 15 minutes. So we have another range, which is this one, and then we have the same order pairing low in a smaller range. This is still good to take because the whole trade stems from the 1 hour to 15 minute sequence, which is down here, but time was not aligned for us to take a proper trade here. When you trade a 15-minute time frame, you should use a kill zone. So 2 to 5 a.m. for London session, and ideally it's 7 to 10 a.m. for New York session, but I would focus on 8 to 11. That's for me more of a sweet spot, but don't deviate from those times on the 15-minute. Now, when you trade a 1 hour time frame, you can enter whenever you want if you use a 1 hour base stop loss. Because a lot of times I have missed trades because I waited for kill zones on a 1 hour time frame and then I just completely missed the trade. So if this order pairing low down here, and then literally price opens up after midnight open and then just blasts up. And this is still a valid setup if you miss the initial entry. So you use a second range after the order pairing low already got hit. Now we're using a CSDOB over here. We're using this one and not this one. If you already know why I should use this one, you have a good understanding of order blocks. I'm going to explain it, of course, because this over here runs the low, right? And what happens afterwards is just a down close candle being formed, then it displaces, right? So this is the actual run into the low, which is a key level. So I consider this the order block and not the little candle over here. Now, a short example on a consolidation. This is what you don't want to trade because it makes absolutely zero sense to look for order pairing highs and lows when you're range bound. And the word already says it, it is range bound. So whatever range high or range low is present, it will not be used for order pairing. It will just reside within the range. You can see highs get purged, price drops lower, doesn't even take out this low, then we don't run this high, then we drop again, we don't take out this low, and it keeps continuously doing that. So once you see this type of price action, you just want to avoid it. Now, let's go to that simulation where I explain how to enter a trade waiting for a confirmation from the 4 hour to 1 hour sequence. And we're going to use a 1 hour CSDOB fair value gap combination. Right, I got a beautiful example over here. Typically, I do a random date, as you guys always know, because I don't like to pre-pick my examples, but it can take a while when you use a random date. So I found this example, which is perfect for this educational. First of all, we're going to start off with the higher time frame, right? You can see this high got run out, and this is a failure swing over here, and then price closes below these candles up here, which is a change in the state of delivery because we're not pushing up higher, no displacement, and we're closing below up close candles. The way candles close here as well, below previous daily lows, and now this candle is going bearish as well, I'm going to wait for the close of this candle here. Now the candle has closed. You are at your trading desk, you want to take a trade, and your bias is bearish, obviously, because you have a nice bearish close below this up close candle. So we're going to look for a sell setup, right? So the first thing you do, we're going to look for a 4-hour to 1-hour sequence. That's what we're going to do. First of all, you want to have a range to trade from, right? So if I take the range over here, we can see this fair value gap here is in premium. That's what we want to have. We always want to have premium and discount, and you don't sell in discount unless you get a lower time frame CSD/OB, which I will explain in a bit. But we can see that fair value gap is in premium. So if I do a rectangle, we know where the POI is. So this is our 4-hour key level. Once we have established our key level on the 4-hour, we want to have a 1-hour order pairing high, right? That's what we're going to do with the sequence. So if I zoom in on the 1-hour, we can actually see a beautiful high being engineered over here, right? So this all lines up very beautifully for a 4-hour into 1-hour sequence. This example over here is when you're going to use a CSD/OB on the 1-hour, and I will show you what that looks like. So if we scroll through all the way to midnight opening, well, let's mark that out as well, because typically with a classic buy and a classic sell day, you want to take a short position above daily opening price, right? That's that manipulation in that daily profile. And then we want to order pair some highs to the lows, right? So we can actually see that over here. We have this low and we have this high. So we have a perfect 4-hour to 1-hour sequence. Now let's scroll a little bit ahead. And then this happens, right? You see a big black candle over here. You're getting fear of missing out because you're not in the trade. Now with logic applied, we could actually trade a CSD/OB or a fair value gap that spawns out of it. So typically you have a smaller range within a bigger range, which is the same thing we're using here on the 4-hour to 1-hour sequence. And we can see this little 1-hour range over here stays respected. Even though this high did not get taken out, we have to be aware that price always runs previous session highs and lows. So we run previous session high, right? That's Asia session. And now we have displacement lower. Now what we can do, I can't see it right now, but there is probably SMT like this. So this high got taken out by GBP/USD, for example, or DXY took out that low. That's why price sometimes does not go into order pairing highs or low. SMT is very important. But what you do over here is you wait for a fair value gap, OB, to get formed. So if we wait one more candle, see if we can get a fair value gap. And we get a fair value gap over here, right? Because this candle is about to close in 1 second. So we have a fair value gap printed over here. The way you approach this, because the 4-hour, 1-hour sequence failed, or it didn't fail, it didn't just deliver towards it. We're going to take a CSD/OB within the range that it formed over here. So we can map out the CSD/OB. It starts as the wick, and we're going to take the fair value gap because price just needs a little nudge when it's in an expansion phase, right? So you have to take the fair value gap, but we're going to place a stop loss on the high. That's the important part. You don't want to greed. You want to put your entry like this and your stop loss on the high. That's important. We're not going to greed and put our stop loss just above the fair value gap because there's still a PD array above it, which we want to use or which can be used. And then we're aiming, if we go back to the daily time frame over here, because we're bearish, right? Zoom out a bit. This is the weekly. Let's go to the daily. The first thing you want to do is aim for a rejection block because the name says it, right? It's a rejection block. So the price can reject over here. So that's the first target you want to aim for. And then you're going to aim for the lows. But we're just going to aim for the rejection block. So risk to reward wise, does this make sense? This is still like almost 3R, right? So this is a good trade setup. We have to put our stop loss on the CSD/OB because it is a CSD/OB. If it wasn't a CSD/OB, we're just wrong about the trade, right? And the direction. CSD/OB should always hold. That's the most important part. It should always hold. Otherwise, you didn't pick the right OB. Because you have to think about a dealing range as well. A dealing range always starts with an old high or low, then a rejection block and an order block. And that order block should never get violated if it's with your order flow. So You can just place an order over here, which is a sell limit. See if it's put in correctly. I think so. Yeah, so there's a sell limit. And what you're going to do is you're just going to stay on the 1 hour. You're not going to go to the 15-minute and watch candlesticks and see how they develop. You are entering based on the 1 hour time frame, and you're going to manage your trade based on the 1 hour time frame. This is what I do, and it prevents me from over managing a trade. And I used to over manage trades a lot, and then I got stopped out break even, or I closed early and then it went to my way. But we're just going to stick to one time frame, and that's what we're going to do. So yeah, let's skip ahead over here, get tagged, and you see price is dropping. Now, at what point do we go break even? Once there is a fresh fair value gap or fresh PD array formed, it gets tapped and then displays lower or closes below those candles again. Only then you can go break even. So even now, while it's dropping, you can go break even here. It might reclaim this fair value gap once again and then go down. So you want to wait for a fair value gap to get tapped and then closure below previous candles, and then you can go break even. That's the rule I use, right? And now it's delivering lower. So we tap this fair value gap here, and we're definitely going to close below this candle here. And that's when you can go break even. Now, this is almost at target. Obviously, you would go break even once price starts to deliver down here. There's no reason to go back up. But taking out the lows and closing below, that's a nice area where you can go break even. Thank you so much for watching this video. Make sure to like and subscribe as always if you enjoyed it. There is a lot more content on my YouTube. I will put a link up over here for my time frame alignment model. Make sure to watch that one. And if you are struggling and you really need some extra help, of course, you can always go in the link in the bio where I teach my students how to trade. And I will see you over there.